Reading a life insurance illustration. So if you've ever been presented a life insurance illustration, there are a lot of columns and you might feel like you're reading stereo instructions sometimes. Now, there are columns that are definitely more important than others, such as the net cash value, the net death benefit, how much am I paying in, my annual outlay, my premium. But while some columns may not be as important as others, it's still good to know them, or at least have a source to better understand the columns, because frankly, it is our money going into the product. I want to have an idea or have someone that can explain it to me properly in the event I want to know or I need to know. So let's get into it. We're going to look at two illustrations here with different companies. We took the companies' names off of these illustrations, but let's have some fun. So first, we're going to look at a 50-year-old male who's paying in $100,000 per year for 10 years. That's a total of $1 million. So if you're ever paying money into a policy, my question would be to you, if we flip positions, where's my money going? Steve, if I'm giving you $100,000, where is it going within this policy? So at the end of the day, money can go toward one of two areas: the premium or the PUA component. The premium, first and foremost, does what? Purchases me whole life insurance, a death benefit, and then eventually builds cash value beginning year 3. In this particular example, you'll see just that. Whereas PUA dollars immediately accelerate the cash value growth. There is a term insurance rider on this policy as well. The purpose of a term rider is that this is a cheap or cost-effective method to raise the death benefit, which primarily raises the MEC limit. So now I've got a permission slip to reduce my insurance premium further and plow more money into the cash value. All right, so let's go through this. Couple components here. One, this $10,715. This is my base premium. So it purchases me a whole life death benefit of $440,000, and that is my premium component. Now, in gold, I see this $1.32 million. That is a term insurance rider. And then to the right, you see this premium of just under $9,300. That is not the cost of the term cost. It does not cost the term rider. It does not cost $9,300. In this particular example, there's right around $1,000 or so that satisfies the term cost. The rest of that rider goes towards PUAs. It is a blended PUA rider consisting of PUAs, accelerating the cash value growth, and a 1-year renewable term rider. There are reports, which we often disclose, and in full illustrations there as well, that displays the full term rider cost and what it renews to each year as well. Then we've got, in green, $80,000. That is a pure PUA component. That's why we see NA here, and that's my PUA rider. So let's go through the different columns here. Year and age and year. Pretty straightforward. What I will say is year 1, age at the end of the year is 51. This illustration is on a 50-year-old male. This particular company displays at the end of each year how old the individual will be. Why I state that is the next example we're going to look at states the age at the beginning of each year. Good to be aware of that little difference there with insurance companies. Annual outlay, $100,000 per year. So what this reads is everything I'm paying in, my total out of pocket, $100,000, consisting of the premium, PUA, and term rider, everything lumped together, that's my net out of pocket. Same thing as 2 columns to the right, the annual net outlay. Exact same thing in that respect. Now the next column, let's scroll up here, annual surrender. What this represents is as follows. The base premium was what? $10,700 and change. What you'll see is while I am paying, the annual surrender is 0. Beginning year 11, we see a surrender of $10,716. Now, when you hear the word surrender, what pops to mind? Surrender fees, charges, typically something that's not good here. Am I penalized? The answer is no, kind of. What this represents here is your base premium of $10,716 that is still due, but you're not paying it. What's happening here is the policy is paying for itself through dividends and interest. Where you're out of pocket, you'll want to refer to the net outlay column here, is still zero. That means you're paying nothing out of pocket each year. That premium is still due, but the policy is paying for it on its own. Then we see annual dividend beginning year. So this company, on this illustration, has a dividend rate of 6%. They have a guaranteed rate of 4%. Where I'm going with this is when you see a dividend column on a life insurance illustration, it often does not reflect the guaranteed rate, only the dividend, which is technically the surplus, everything above the guarantee. So in this case, guarantee of 4, total dividend of 6%, gives me a difference of 2%. That's my surplus. So the point here is this dividend column represents only a 2% surplus, not the company's total dividend rate. That can be confusing as we dig into these illustrations. Perhaps you've done that in the past to say, hey, the company's got a 6% dividend rate. This thing's not even 2%. Like, what is going on? It's because the guarantee is not included in the dividend column. Then we've got the basic policy cash value end year. This is what I will often refer to as a useless column. The reason why is it represents if you only paid the base premium of $10,716, and that only yielded the guaranteed rate of 4%, no dividends were added, you added nothing into PUAs, no riders, nothing like that. Again, you just pay the base premium and you only receive the guaranteed rate of 4%. Here's what the cash value would look like. First 2 years, overcharges me for the death benefit. That's why I see nothing. Beginning year 3, comes back and capitalizes over time. Next column, cash value of additions end year. So what this represents is money you add into the PUA component. So remember, we added what, $80,000 into the pure PUA, and then you also had that combination of money going towards PUAs and the term rider expense. So this displays cash value of additions, money you add to the cash value outside of the premium. This does not in any way, shape, or form reflect dollars you add to the base premium component. $86,000. Year 2, $176,000. It does reflect the interest, any dividends and interest added on to the policy as well, in addition to your payments too. Net cash value, this is your money column. What you have access to as the policy grows, that's really what we want to track as far as the cash value growth over time. Then we've got total paid up additions beginning year. This is a valuable column to be aware of because typically when we hear paid up additions, we think what? PUA rider, money that I can direct towards the cash value. Here, what it represents is the amount of paid up additional death benefit, life insurance, that is purchased from your cash additions. So let's go through this slowly here. If you add, or a 50-year-old male adds $86,000 into PUAs, into a cash value add, that will purchase him another $261,000 of whole life insurance death benefit. Remember those models where we talk about your money can go toward premium or PUAs? PUAs accelerate cash value, but if we put $1,000 into PUAs, I'll see it show up in cash, but I also might get another $3, or I should say $3,000 in death benefit. That's exactly what we're seeing here. We pay an 86, you see just about 3 times show up in added whole life insurance death benefit. Amount of 1-year term. This is a term rider. that gradually decreases as time passes. The main reason we attached this policy, or I should say this term rider to this policy, is it is a cheap way to again raise the death benefit. Here's our net death benefit in the far right, just under $2 million. Why would we want to add $1.3 million in term insurance to this policy? Well, the reason why, you'll see disclosed on the bottom right-hand corner under the MEC limit, $100,000. So this individual wanted the ability to pay up to $100,000 per year. So we solved for the minimum death benefit, just about $2 million, to obtain that $100,000 MEC limit. What that accomplished, minimum death benefit, equates to minimum insurance expenses based off of that 100K payment. Know this can be complex. Next page. Very similar here in respect to the columns. The only difference is that we looked at a reduced paid up option, and all that did was kill the surrender column. So now we see no annual surrender here, meaning that premium of $10,716 is gone. Once we go reduced paid up, even if we want to continue to pay into it, we no longer can do so. So the disadvantage is we cannot add money to the policy. The advantage is that premium is gone, so we remove what I'll refer to as the drag. We cut the drag, so now all dividends and interest can be kicked back into the cash value, which is attractive. Let's look at another company here. All companies are similar, but have things termed a little bit differently. There we go. A little too fast. All right. So, different insurance company, same 50-year-old male, but only paying in $100,000 for 5 years. Again, where's the money going? Premium, $9,100, buys him a death benefit of $330,000. That might get him a MEC limit of 14 or 15 grand. Not that much space. Total death benefit, we'll get down to this in a minute here, $2 million. We'll see here target additional benefit, just under $1.7 million. That is term insurance that we added to the policy. Again, cheap or cost-effective manner to raise the death benefit, which raises the MEC limit. Cost for that term rider is disclosed right here. That is the first year cost, just about $1,000. The cost will actually decrease each year thereafter as well, and I'll show you exactly why here in a second. Almost forgot the most important piece, paid up additions, just over $90,000. So as we look at this guy, a couple things we'll see. As illustrated, policy changed to reduced paid up beginning of year 8 in this example. So exercised the same reduced paid up option, but a bit earlier, and we funded for 5 years. So policy year and age at start of each year. So this is a 50-year-old male. The only difference is year 1, it reads age 50 instead of age 51, like the last illustration we just saw. Next, base policy annual premium. That's the $9,100. Base guaranteed cash value. That's that useless column I'll refer to. What this again represents is if you only paid the base premium of $9,100 and that only yielded the guaranteed rate, you added nothing into PUAs, added no riders, nothing like that, this is what the cash value would grow to over time. Annual dividend or end of year dividend. This company's dividend rate, 5.65%. Guaranteed rate, 4%. So like the last illustration, this represents the surplus only. Everything between the guaranteed rate and total dividend rate, which is 1.65%. Net premium, net after-tax outlay, my total out-of-pocket payment, pretty straightforward. Cumulative net after-tax outlay, this tallies my total payments over time, $500,000 total. Cash value of all adds. So this represents money I add into PUAs. That $90,000 and change, if you remember that up top, this is how much of it, after the term rider cost as well, is left over in cash value. Column immediately to the right, total face amount of all adds. This represents how much additional whole life death benefit is purchased by the PUA payment. So if I add $88,000 into cash value, that buys you another $275,000 in death benefit. Face amount of 1 year term. This is the 1 year term rider. As your whole life goes up, your term comes down over time. Then we've got the net cash value and net death benefit. Breaking even year 4, very attractive. The company only overcharges us for the base premium in the first year in this example, not the first and second. And then we can also run a custom report with custom guaranteed values based off of our total net payment. Know this is a lot of information. I had fun with it. If you have any questions, feel free to reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.